can you give us a slightly more specific definition of GDP, how you think GDP can affect markets?
Traders care because it tells how fast the economy is growing or shrinking, and it also directly affects interest rates and equities.
If you get a situation where the previous release was negative and people are expecting a positive release from this quarter, but it actually does show a technical recession, then maybe that's one of the biggest potential scenarios where you could see markets really moving strongly.
Yeah, when expectations align, then you have big moves happening on the charts.
Do you want to look at some specific examples of GDP coming out with a positive or negative surprise, how that affects the chart?
In Q4 of 2023, US GDP came out stronger than expected, around 3.3%. But that's not always bullish, because if we take a look at the Nasdaq chart, for example,
Hello and welcome back to Exness Trading Talks. In this week's video, we're going to be talking about GDP. Last week, we talked a bit about Purchasing Managers Index, or PMI for short. And I encourage you, if you haven't done so already, please subscribe, turn on notifications so you're always aware immediately, if you'd like to be, when the next video in the series, Trading Talks, is released. Here, we're going to be talking about gross domestic product, GDP, what it is, how it affects markets, and specifically how markets react to surprises in these data with reference to some specific examples. I'm Michael Stark, Financial Content Leader, and joining us to give us examples and opinions is Antreas Themistokleous, Trading Content Specialist. Welcome, Andreas.
hello, Michael, and thank you for having me.
Anytime, thank you for coming on. And GDP, most of us know what GDP broadly is, but can you give us a slightly more specific definition of GDP? And I think in particular, it would be great if you could highlight how you think GDP can affect markets, both in general and specifically. We'll get on to the specifics later.
Yeah, so it's a measure of a country's economic output. It tracks the value of goods and services in an economy, and it shows how this economy is performing. Is it growing or is it shrinking? Now, traders care because it tells how fast the economy is growing or shrinking, and it also directly affects interest rates and equities.
Okay. And within the overall category of leading and lagging indicators, various economic indicators can be leading, but GDP is not one of them, right?
Yeah, no, it's not fresh data.
Yeah.
But in the case of surprises, it creates volatility.
Yeah.
But it's not in any case leading indicators.
It's just one of the, if anything, probably one of the more lagging indicators of the main economic ones. Okay. And some of the main instruments, what do you think of when there's a GDP release, whether it's the USA or any other country, what do you think are some of the most important instruments that we want to be looking at for movement around the release of GDP?
It's usually Forex pairs and equities, because when you have, for example, the US GDP, that obviously affects the dollar and all the pairs that it's traded against it. So Forex is greatly affected by specifically the GDP, and also equities and stocks.
Okay, makes sense. And if you'd like to know more about how actually to trade or some of the options for how to trade GDP releases, then I encourage you to click on the link which is in the description just below, and you can read the article on Exness Insights, which is all about that. And if you would like to receive updates and more information and details about economic releases in general, not just GDP, and how they have affected and are affecting instruments, you can click on the other link in the description, which will sign you up for Exness's weekly report. So if we think about these instruments and how they're affected by GDP, and GDP as a lagging indicator, there are usually several different revisions of GDP data. So like for the USA, certainly at least, it has the flash, or it has the advance release of GDP, second estimate, and the final. So can you give us a lowdown on that? How can these differ from each other? Which ones do you think, or in your past experience, have brought the most volatility or the most potential opportunities?
So the advance estimate comes out approximately a month after the quarter end. It's incomplete and prone to revisions, but it's the one that actually moves the market because it's the first look of the market participants into the specific country's economic conditions, if you wish. Now, the second estimate has more data to it. It's more accurate, but it's not that big of a move because traders already have an idea of approximately what the number might be. Now, the final estimate rarely moves markets, but when we get, big revisions, especially to the downside, then that means something's wrong. I mean, if the second estimate would be like 5%, and then the final comes out at 1%, which is like a big difference to the two values, right? Then and it's also downward revision, then something's wrong. Volatility picks up, and it's usually bearish news for the specific currency.
Yeah, it makes sense. But I mean, what examples can you cite? Do you want to look at some specific examples of GDP coming out with a positive or negative surprise, how that affects the chart?
Yeah, so in Q4 of 2023, we had the US GDP came out stronger than expected, around 3.3%, right? But that's not always bullish because if we take a look at the Nasdaq chart, for example, and we go back to January of 2024, we will see that the tech in general sold off while the dollar rallied because traders feared the Fed would have delay cuts, right? So in that case, growth wasn't the problem, but policy reaction was.
Yeah.
So that's why we see a big sell-off on Nasdaq.
And that also potentially could apply in reverse, because if you see, it's not so common for the USA maybe, but for European indices, if you see GDP missing estimates, then everybody's like, okay, whatever. Central bank's just going to cut rates, so who cares? Cheaper debt means the price is always going to go up anyway. But then, of course, that depends very, very much on sentiment, certainly. Yeah. And maybe we could also think about Forex, because recently we've had some GDP releases from both the Eurozone, the EU, and the USA. So especially when you get that on the same day as we did in July, then maybe I think we could contrast that with each other and also with what happened on the chart.
Yeah, so the expectations on the US GDP was to go from negative 0.5% to 2.4%, whereas the actual figure came out at 3%, therefore beating expectations, right? Whereas the EU was expected to decline from 1.5 to 1.2, came out 1.4, okay, beat expectation, but not by as much as the US did. So the immediate aftermath of that was that if we check the Euro-USD chart, we will see that immediately after that release, we see a big sell-off on Euro-USD. So that's another example of divergences between two countries reflecting on the charts.
Yeah, okay, that makes sense. And I think something else that we, especially like in the early 2020s, we have a lot of expectations of recession. Loads of people have been saying, oh no, the crash is coming, get rid of it, like predicting recession constantly. And the definition of technical recession to successive quarters of GDP declining is something that was like very much in focus also for American politics. Like that was certainly in focus. So I think it's also something that can be really critical is if you get a situation where the previous release was negative, right? And people are expecting a positive release from this quarter or the quarter that's just passed, in other words, no technical recession, but it actually does show a technical recession, then maybe that's one of the biggest potential scenarios where you could see markets really moving strongly.
Yeah.
Because you have the context and also the surprise aligning together.
Yeah, when expectations align, then you have big moves happening on the charts. Yeah, that's true.
And overall, GDP, we've talked about its influence on, or the influence that it can have on monetary policy, although it's a lagging indicator. Do you think that there are any clear influences or less clear influences between GDP and information like inflation or PMI or job data or anything like this?
Okay, so you have two scenarios, let's say, a low inflation environment and high inflation. When you get low inflation and good GDP numbers, that's when equities go up. When you get high inflation and strong GDP, that means you have a strong economy, which is already inflated, right? So you get higher rates, tighter financial conditions, so you get lower equity valuations, because higher rates, that means that cost of financing your operations now it's higher, so you get lower valuations. So equities tend to not perform that well when you get high inflation and good GDP. And it also affects especially growth stocks and tech.
Okay, that's really good. That's something I'll definitely intend to explore further. So thanks very much, Andreas, for being here, for giving us these insights and your opinions.
Thank you very much.
And thank you to our viewers also for watching. And next time, we're going to be back with Exness Trading Talks to talk about oil and some of the data that's affecting oil. And we'd encourage you to subscribe and turn on notifications so that you're aware immediately when next episode has been released next week. And hopefully you'll join us again there.